Welcome back to Primary Source China Investment. This week, peng.guo and I are on show L2, and we wanted to talk about two different topics today. And the first topic is returns of the stock market and GDP. How are those related? How are they not related? And what it might mean going forward. And then the second topic we're going to get into a little bit later is, remember our portfolio of China without China. So US stocks that do a lot of business in China. So those are the two topics today. And let's kick it off with this idea of stock market returns and GDP growth. So as you can see, GDP growth has been very, very strong. And regardless of what you think of China's data, we have a lot of it, and for a good chunk of time. I was having a discussion with a friend of mine about crypto, of all things, and I realized there's some fundamental assumptions about asset classes that don't hold up under scrutiny, like Bitcoin and inflation, for example. But peng.guo and I are not Bitcoin experts, maybe a little bit of inflation expert, but certainly not Bitcoin. But that's where true. We do have a lot of experience is with China growth and the stock market. And without going too far back, we looked at CSI 300 and GDP going back to 2006. And I won't tease the lead anymore, but GDP growth and the stock market returns are not correlated. This is obvious by looking at the data. There's two other observations we can see by looking at this side by side. One is that volatility, while still high by US standards, is significantly down overall. And two, GDP growth is slowing.
I think China also think about what the driver for the GDP growth. From the history, it's pretty clear. It really came from the reform. 30 years ago, and China started getting the reform, and also starting with the business dealing with the world. So as long as China integrate with the world global economy, so they get expand quickly. That is a major driver for the China consistent growth in the past 30 years. And also in the different sector, it's pretty clear. Like the real estate is pretty much lead 30% of the GDP growth in the past few years. In the past 30 years. And right now, the driver is get a slowdown, and China is looking for other new industry, like the new clean energy and a lot of the new construction infrastructure. Another big point is China growth is still with the money supply. So M2 growth pretty much like the 8% to 15% every year. A good thing is if you see the CSI 300 or Shanghai Composite Index, that's a growth is pretty much can match or beat the money supply growth. So really, the generally stock market is driven still by the money supply or match that speed. That means if you hold like the lower return asset, that you mean you pretty much lose the money. So like the treasury bond or some things consistent, they cannot beat the inflation. So you have to allocate in the equity or high growth area.
Yeah, I don't have the numbers off the top of my head, but a lot of this growth has also been debt fueled. If you look at debt to GDP or consumer debt or corporate debt, there's been a huge explosion in debt in the last 10 to 15 years on the balance sheet of China Inc., not to mention specific companies.
That's true. That's also triggered a problem. We see this kind of the cycle for many times. China try to do some adjustment or make the policy to doing like that. That in that case, you will see like over the past 10 years, different sectors they have performance significantly different. 2010s around that area, like the financial sector performs very well. And then consumer staples, and then right now the new clean energy area, they get a pop up. So all those things, the investment logic actually is pretty clear. So we don't know which sector performs best, but the logic really match with economic growth as well as the government policy change.
Yeah, the debt growth is interesting because as it continues to expand, the marginal return of each additional dollar of debt is really under pressure. And if rates stay artificially low, you're going to have incentive to keep issuing, to keep taking on debt. So you do have this friction in the market right now where economy needs to deleverage somehow. Government understands that it needs to deleverage, but it's just such an easy way to continue the growth. But you can see just from this chart, the annual growth rate, growth is declining. And I think it does have to do with this marginal utility of additional debt.
That's right. And I think everybody realizes the problem. They suffered the problem for a long time. Unfortunately, they just cannot stop it.
Yeah, it's too big. I mean, the economy is now very, very big, whatever. It's $16 trillion or something equivalent. So you can't stop on a dime and say, lose 30% of your economy by getting out of the real estate business. It's just not practical. So there's this transition period that's happening right now. But I think the point that I wanted to make here is you can't look at growth and stock market returns because they're not correlated, right? If you just do a correlation analysis, it's like 50% correlation, which is basically nothing. So the correlation is not there, which means you have to look at policy to determine your return. And that brings us to our second topic today, which was back a number of months ago, we put together this portfolio. Back in July, so I have the date here. Back in July, we were thinking about how do you get China exposure without actually worrying about if you're in A shares or H shares or US listed stocks? So we found a portfolio of 10 companies. And those 10 companies all have more than 50% of their sales on the mainland or mainland adjacent, which is Wynn and Macau, because Wynn is in this portfolio. Interesting, it's one of the poorest performers. But if you look at this portfolio now, and I calculated this by taking an NAV of a simple portfolio of 100,000. That portfolio is up just under 10%. And that includes a huge sell-off Friday market on the 26th. There was a huge sell-off in the market. But if you look at that portfolio, was up 10% from July 28th to November, close of business November 26th, up 10%. A share was up about half of that. EWH, which is the Hong Kong ETF, was down about 7%. KWEB was down 13%, and the S&P is up about 5%. So the S&P and A share, interestingly enough, is about the same, two totally different markets, but our portfolio has outperformed that. Of course, people are going to say, oh, there's concentration risk and all those other things. But the point that we were trying to make back in July was that you can get China exposure without actually owning Chinese stocks.
That's absolutely right. So I think a U.S. market as well as international market is already provide a lot of the good exposure or a high correlated exposure to the China market. But the problem is investors, they don't have enough resource or expert to understand the underlying assets. So they just think I get exposure, everything should be fine. So they're really from the country exposure perspective to doing the asset allocation. But in fact, if you want to do the good investment, you have to at least from the sector level. So that really means that it's pretty hard work the easy way, maybe you can select the multi-assets to build the balanced portfolio. But unfortunately, they just most of the time they choose the one or two sector highly biased in a certain area, and the style changed in the Asia market, and then they will suffer the lose or the volatility to doing like that. So that means they have to improve the investment philosophy as well as the methodology to get a more balanced or diversified portfolio to do it.
Absolutely. There's like we talked last week about some of the ESG sectors have done very, very well. Some of the larger sectors that are more traditional have done pretty poorly. And of course, I'm going to put up another chart of the year-to-date performance of ASHR versus Hong Kong versus KWEB, because ASHR is down I think 5% year to date. And Hong Kong ETF, which is EWH, is down about 50 bips year to date. But our famous our favorite punching bag, KWEB, is down almost 40%. You can see it on the bottom there. The reason is, and again, we still believe this, that US listed Chinese stocks are under pressure. A few may bounce, some news may come out, but they are under significant pressure.
Yeah, I think if we see the market performance, we should understand there's a lot of risk reflected in here. Not just the China risk, and it's really like the global risk also reflected in China equity or whatever, and asset class performance. So we have to not just in China itself. So that it makes things is difficult and more complicated. And also China and the US, the two big markets, they could affect each other. I think like this Friday, SP 500 dropped like the 30 days moving average. That's a trigger pretty bad signals for the short term. So if there's a US market get a drop for any reason, maybe interest rate get a increase, or there's a new virus impact the global economy, some of things. Obviously, all the Asian market, USC, drop very much more to doing like that. Actually, all the global risk asset class, they still have a high correlation.
Yeah, that's part of the discussion. People always say, well, it's a non-correlated asset class. Well, it turns out that all assets are correlated when things go really horribly wrong. So it's very difficult to get a clean hedge, But I did notice that U.S. bonds performed as expected, which was bonds were up, stocks were down on Friday.
Yeah, another way is probably just the mix, like the asset class with the strategy related product together. So that is because strategy related maybe have a lower correlation with asset class, or that's just increase complexity so as to test your investment ability to do that like that.
Correct. And probably most investors do not need to increase complexity. That's what we're trying to do here every week, is tell people, what's the easy way to get exposure, how to do allocation, and try to keep it simple. And hopefully we're getting the content out to the people that need it most. We appreciate you tuning in this week. Peng.guo and I will see you next week.
Thank you.